and Gas Innovation Center, the Decommissioning Presentation Series. My name is Klaus Otto and I'm the director of the center. Peter Nyland, recent article in Boiling Cold, reported on the forecast cost of Australia's decommissioning bill being 76 billion Australian dollars. Today's podcast covers issues around estimating the decommissioning liability and what factors affect when production stops. It is my pleasure to introduce Ineke Rebos of Teleology Energy and Dean Stewart of Sequent Consulting. Both are adjunct research fellows with the center. Also joining us today are Professor Grantley Taylor and Dr. Roberto Aguilera. Both are from the University Business School. On a note, this video is intended for commentary and general information only. We have included Curtin's legal notice and disclaimer for you in the last slide of this video podcast. I will now hand over to Ineke.
Thank you, Klaus. In a recent report from Wood Mackenzie, the cost of decommissioning over the next 30 years in Australia was forecast to be 76 billion Australian dollars. That's a huge number by anyone's measure, but what makes that number even more attention-grabbing is that the accuracy of the decommissioning estimates can vary wildly depending on where you are in the asset's life. Logically, the level of definition around the scope of the decommissioning and how that will be undertaken translates directly into how accurate the estimate is. So $76 billion could be an understatement of the final decommissioning bill. What some people may not realise is that a portion of that bill will be funded by offsetting the decommissioning costs against the asset's petroleum resources rent tax receipts. In effect, the rent tax that would have been taken by the Treasury in the last year or years of the asset's producing life will instead be used to pay for potentially about 40% of the decommissioning costs. We will cover in an upcoming podcast what is happening outside Australia with regards to marshalling these huge costs and decommissioning strategies adopted by other countries. Also, how decommissioning supply chains are being developed and how other countries are using industry and governmental collaboration to improve how decommissioning is both planned and executed. Back to the $76 billion bill. Today we're going to talk about the timing of decommissioning and making financial provision for the decommissioning liability. Neither Dean nor myself are economists or accountants, so we have a couple of special guests joining us today. Dr. Roberto Aguilera, who's a senior research fellow at Curtin University, and also Professor Grantley Taylor, who's deputy head of the School of Accounting at Curtin. Dean, can you set the scene and outline the process involved in the development of an oil and gas discovery, please?
Yeah, okay. When we look at the life cycle of an asset, we start with vacant acreage. From there, seismic surveys are undertaken, geological and geophysical studies undertaken, and an exploration well is drilled and reservoir assessments are then undertaken as well. We then, assuming we have exploration success, move into the development phase where we assess development options, look at the various concepts, and undertake a FEED, including developing a very robust cost estimate and a basis for taking the final investment decision or FID. After the asset is developed, production begins, followed by hopefully many years of operations until eventually the decision is made to cease production and decommission the facility.
Let's talk a bit about when in the life cycle of the asset do we need to be thinking about the mechanics of how we're going to do the decommissioning and what all of that will cost.
Well, fundamentally, decommissioning should be considered at every step of the life cycle of an asset. Under UNCLOS and IMO, everything should be removed as soon as possible unless the state allows the installation or structure to be left wholly or partially in place, where this is consistent with the IMO guidelines and standards. The IMO guidelines, which apply in Australia, require that all facilities installed after the 1st of January 1998 should be designed to be able to be removed. And domestically under the OPGGS section 572, full removal is the base case. But under consent to surrender title section 270, arrangements other than full removal may be permitted if satisfactory to NOPSEMA. The wells still need to be plugged and abandoned.
So the takeaway from what you've said is the facilities need to be designed to be removed, and this fits with OPGGS and the Commonwealth decommissioning policy on early planning for decommissioning is encouraged.
Yes, and the policy reads, decommissioning should be part of an overall field development strategy, as well as the design and concept selection stages of facility development, to ensure decommissioning obligations and the associated costs can be addressed in the overall project costs and planning.
Okay, so let's look at the different types of costs or liabilities that we need to account for. In reading OPGGS and IMO, there are different costs or liabilities associated with decommissioning. The first is the decommissioning or the restoration cost, and this is the most obvious cost when we talk about decommissioning. It's the cost of the plugging and abandonment of the wells and the removal of the structures and the equipment. The second type of cost is the ongoing monitoring cost. And the third cost is actually a liability arising from the wells and the structures or installations that are decommissioned in situ. Here we have three very different types of costs, each covering different scopes or responsibilities, and each having varying degrees of uncertainty around their scope and the timing on when these costs may or will be incurred. So let's first of all talk about the decommissioning or the restoration costs. As we touched upon earlier, both internationally with UNCLOS and IMO and domestically with OPGGS, everything should be removed unless the state allows the installation or structure to be left wholly or partially in place. For Australia, that requires that NOPSEMA is satisfied where there is less than full removal. An important point to take away from this is the expectation is full removal. Only when the state, in this case Australia, is satisfied can less than full removal occur. We cannot assume that less than full removal will be approved. Dean, can you please explain what is included in the decommissioning or restoration cost?
Okay, well, the first thing to acknowledge is that this cost will be incurred. As a title holder, you have an obligation to remove structures and installations. The decommissioning or restoration estimate is the estimated cost to restore the location, including removing the topsides, the substructures, well P&A, and removing subsea structures and pipelines. However, as you can appreciate, there is a level of uncertainty which is going to affect how accurate your restoration cost estimate is. The most obvious uncertainty is when will the asset cease production? According to the IMO, decommissioning should happen as soon as reasonably practicable after abandonment or permanent disuse of such installation or structure. The OPGGS does not put a time frame on when the decommissioning should happen, but does say the title holders have an ongoing obligation to remove all equipment and other property in their title area that is neither used nor to be used. So, Dr. Aguilera, can you explain when does the cessation of production occur and what influences the decision to actually cease production?
Yes, thank you, Dean. First of all, let me explain what economic theory says on the subject of when it makes sense to produce. In the short run, say a period up to a few years, existing production capacity will be used to produce oil and gas so long as the variable or operating costs are covered by the market price. This includes the expenditures that vary with production, including, for example, labor, energy use, also some taxes and royalties. In the short run, fixed or capital costs have to be paid anyway, so companies will keep going even if they're losing money each year as long as operating costs are covered. In reality, however, producers might not cease production when faced with that situation. After the oil market crashed severely this year, due to declining consumption caused by the COVID pandemic, prices did fall below the operating costs of many companies, yet some chose to keep producing for various reasons, including legal or regulatory obligations, or because of the technical difficulty of shutting down production, or because of expectations of a rise in price in the near future. On the other hand, if we're talking about the long run, average fixed or capital costs must be taken into account as well. Therefore, long-run prices must cover those expenditures too, including a rate of return on invested capital. So that's the theory, Dean. Though in the industry, companies use economic evaluations to determine the viability and length of their projects, usually with discounted cash flow analysis. This involves estimating the annual future cash flows over the life of the project. Of course, inflation means that $1 today is worth more than $1 in the future. So this is taken into account by discounting the future cash flows to today's value. That means that the so-called time value of money is being considered. The goal of the companies in most instances is a profit or net present value maximization. Net present value, or NPV, simply adds up all the discounted annual cash flows, including the outflows and the incoming. If the NPV is positive, the project can go ahead, as it will create value for a firm. The other important measure is internal rate of return, IRR, used to compare profitability of projects. IRR is a percent value representing annualized rate of earnings. If the IRR is greater than the firm's cost of capital, which is also a percentage representing the interest it pays for debt and the return it gives investors who buy shares, then the project should go ahead. So, in summary, the length of production of a petroleum project depends on its economic viability. The cash flows, logically, will be dependent on estimates of the recoverable oil and gas reserves, the production profile, and monetary values such as revenues, capital costs, and operating costs. The estimated costs of decommissioning the project should also be included. All these costs and the revenues will in turn be dependent on the oil price and several economic variables, such as inflation and interest rates.
Okay, so how might the cessation of production date then change?
Given the uncertain and dynamic nature of many of the factors already mentioned, it stands to reason that the cessation of production date could move around. Recoverable reserves, for example, is a moving target that can grow or shrink based on market conditions like the oil price, or based on advances in technology that can alter production profiles and decline rates, or based on improvements in reserve assessment techniques, to name a few. The input costs to a project, both capital and operating, might also change over the life of the project. For instance, the prices charged by service firms tend to fluctuate with market conditions. Furthermore, changes in the assumptions related to economic variables will alter the project economics and therefore the length and cessation of production. These include changes in oil and gas prices, which as we know can be drastic, but also exchange rates, inflation rates, and interest rates. All of these factors will change the values of the criteria used to evaluate a project economically, like net present value and internal rate of return. To account for all these potential changes, sensitivities can be run in the economic evaluation to take into consideration the inherent uncertainties involved in oil and gas projects, particularly the ones with longer lives. Finally, I'll make a comment about the low price environment being experienced this year, given that it has brought up discussion about the life cycle of oil and gas projects and therefore decommissioning. On the one hand, the low prices make some projects uneconomic and therefore may bring nearer the termination of production and therefore the decommissioning of those projects. On the other hand, companies have gone into short-term survival mode and considerably reduced expenditures wherever possible, so it could make the companies reluctant to want to spend on decommissioning. Also, reducing costs and improving efficiency in the low-price environment may improve economic viability and thus extend the production life of some projects. In any case, in my view, it's likely that the extremely low prices seen in recent months will be short-lived, as the mobility restrictions related to the pandemic are lifted, leading to rising oil consumption, and as production is curtailed from major producers like Saudi Arabia, Russia, and the United States.
Well, thank you, Dr. Aguilera. In addition to the factors Dr. Aguilera talked about, there are other uncertainties that will affect the accuracy of your estimated decommissioning or restoration costs, including you don't know whether you will get approval from NOPSEMA for a partial removal or whether you will have to remove everything. It is not possible to say with any certainty what the prevailing market conditions will be when you tender the decommissioning work in, say, 25 years' time. Lastly, whilst you will maintain the facility, you don't know what the condition will be after 25 years of operation.
The second category of cost is the monitoring cost. Under IMO, anything above the surface of the sea needs to be adequately maintained to prevent structural failure, and the state needs to identify who is the party responsible for the navigation aids on the remaining structure and for undertaking periodic monitoring and ensuring the navigational charts show the remains. Under OPGGS, NOPSEMA may require arrangements such as monitoring and marking of the remaining property, as well as monitoring of the wells, potentially resulting in extended decommissioning periods and delaying the ultimate surrender of title until such monitoring is completed. OPGGS does not state the frequency or extent of the monitoring activity or the number of years it needs to continue for. Notwithstanding that, there is uncertainty as to the extent of the monitoring. This cost will be incurred. The last category of cost is actually a liability. Residual liability could arise where a third party suffers loss or injury or their property is damaged due to the decommissioned residues or the wells. With residual liability under IMO, the state, in this case Australia, must ensure that legal title for the residues is unambiguous and that responsibility for maintenance and the financial ability to assume liability for future damages are clearly established.
Okay, so that's Australia's international obligations, but what about the OPGGS and domestic obligations?
Well, OPGGS does not currently include any statement on post-decommissioning liability for the wells and the residues. Instead, this is dealt with under the law of tort. With regard to pollution emanating from the wells or the residues, OPGGS does say the polluter pays principle applies. And this means that the cost of preventing, controlling and cleaning up any pollution rests with the polluter rather than the affected state. The issue of post-decommissioning liability was raised as an issue in the discussion paper back in 2018, and a response is due this year. So we will have to wait and see if the position on residual liability changes. Because no harm or injury may occur, how this liability is accounted for is different. Okay, so Dean, given the importance and the requirement for removal under IMO and OPGGS, what is the correct level of attention and resourcing that should be given to decommissioning before decommissioning becomes an imperative?
Well, in the pre-development and development phase, when bidding for blocks, there needs to be a justification for the bid, which usually includes commitments to seismic, exploration and appraisal drilling, and this is based on high-level estimates and economics. Assuming the pre-development stage is successful, then comes the development process. All companies will engage in some form of assessment definition phase work to establish the optimum development concept. This will then progress through a feed phase to a final investment decision, or FID. One clear objective of the feed is to establish robust costs to allow the project to proceed. At this stage, the calculation of the decommissioning cost might be as rudimentary as, say, a percentage of the overall project development cost, or it might be a very high-level estimate. Either way, at this point, when you're about to take FID, the cost of decommissioning will likely be dwarfed by the development cost. For example, a decommissioning cost of 150 million in 20 years' time represents only about 22 million today, which pales into almost insignificance against a field development cost that could be upwards of $1 billion. When you compare these two figures, you can appreciate why the focus would be on the development costs, minimizing cost overruns and avoiding delays to first gas, rather than on the accuracy of the decommissioning cost. So at the FID stage, because the level of definition is low around how decommissioning would be carried out, the cost estimate is probably a class 5. with an accuracy of potentially up to plus 100%. Once we get into the execution phase and start to spend money developing the asset, things start to get really interesting. Professor Taylor, from an accounting perspective, when and how does the liability need to be reported?
The accounting standard AASB 116 property, plant and equipment, or the equivalent IAS 16, requires firms to include or capitalise an initial estimate of costs of dismantling, removal of the asset and restoration of the site. The decommissioning provision is not recognised in profit or loss, but as part of the cost base of the asset. The decommissioning obligation is recognised either when the item of property, plant and equipment is acquired or as a consequence of commencing development of the item of property, plant and equipment during a particular period. What that means is that as soon as you commence work to develop the asset, you need to recognise the obligation to remove the asset in the future and to restore the site. Developing the asset could be as early as when you drill a well or start to construct the topsides. Australian Accounting Standard AASB 137 provisions, contingent liabilities and contingent assets, or the International Accounting Standard equivalent IAS 37, then requires recognising a liability when there is a present obligation arising from past events. AASB 137 contains provisions on how to measure decommissioning, restoration and similar liabilities. The decommissioning liability or decommissioning obligation in your accounts is the present value of your share of the estimated cost to restore the location site, plug and abandon wells, removal the topsides, the substructure, any subsea structures and the pipelines. The decommissioning liability is a liability on the books and as such affects the value of the company's ability to borrow money and its profitability, which ultimately impacts the shareholders. The decommissioning liability should be based upon current legal and regulatory requirements, current technology, current pricing levels. However, if the title holder's assessment of the probabilities or credible evidence shows that the basis of the decommissioning liability is more likely than not to change in the short term, the title holder may change their liability estimate based on that. However, this should be disclosed in their accounts. Pronunciation AASB Interpretation 1 or the IFRS equivalent changes in existing decommissioning, restoration and similar liabilities sets out the requirements on how to account for the effects of changes in the measurement of existing decommissioning, restoration and similar liabilities. So the liability should be regularly reviewed to reflect the improved estimates and changes in legal and regulatory requirements, the state of technology, changes in your discount rate and pricing levels. On a final note, a contingent liability may be recognised as a result of legal action or similar to rectify damages during the course of operations or as a result of residual environmental damage or in fact injury.
Thank you, Professor Taylor. The message is account for decommissioning provision as soon as you commence work to develop the asset, state the basis for calculating the liability and disclose changes. Liabilities from decommissioning residues should be recorded as a contingent liability. If you are an officer of a company involved in financial reporting, you need to be satisfied that the accounts, including the decommissioning liability, are amongst other things accurate and adequate disclosure has been made. Forecasting is a continuous process in the oil and gas industry, and as Dr. Aguilera talked about, many factors can affect the date when production ceases. Events can occur that bring the production end date forward, but also conversely, the cessation of production date may be delayed and pushed out when a new well is tied into the facility. Unfortunately, as we have seen recently with an oversupplied market, where demand is depressed, oil and gas prices plummet. Assets that were economic suddenly become challenged and even sub-economic, bringing production end dates forward. In this environment, decommissioning suddenly becomes a hot topic, and the practicalities of engineering the removal gathering the necessary data, and getting your approvals in place comes into sharp focus. From an approvals perspective, if your cessation of production is going to be earlier than is forecast in the approved field development plan, you need to make an application in advance of cessation of production to the Joint Authority for a variation of the FDP. On the other hand, if your actual production before cessation of production exceeds your production forecast in your accepted FDP, you don't have that same obligation, but of course you should be talking with the regulator about your forecast cessation of production.
It's worth saying that decommissioning doesn't necessarily happen straight after the production stops. As OPGGS isn't prescriptive about the time frame when decommissioning should occur, it is possible for considerable time to elapse between when the asset stops producing and when it's actually removed. Now, we've seen this with ENI's Woolly Butt field, where production stopped in 2012, with the decommissioning plan being accepted in 2019, and NOPSEMA requiring completion of the decommissioning activity by 2024. That's 12 years after production had stopped. Under a scenario where there is a significant period between cessation of production and decommissioning, yes, the expense of decommissioning is deferred, but decommissioning may be more expensive. And that's because you will still have to maintain the asset in accordance with the commitments you've made under the WOMP and the EP and the safety case. You may also have to carry out subsea surveys. And then there's also the annual cost of maintaining the necessary permissioning documents like the WOMP and the EP and the safety case, which have to be updated every 5 years and also need to be updated to reflect the current operating case. And all of this costs hundreds of thousands of dollars annually. Any financial security that's in place will need to be maintained for longer, which has an associated cost. And importantly, the asset may deteriorate, which may make its removal more complex and ultimately more costly. Then there's the risk that the title holder's financial status may change, potentially making them less able financially to fulfill their decommissioning obligations. So whilst delaying removal defers the cost, it will add extra cost. It creates complexity and can increase the risk associated with decommissioning. The takeaway message is having a quality cost estimate for your decommissioning obligations is important, especially once you are reporting these liabilities in your financial accounts. The better the scope definition, the more accurate your estimate will be, and the clearer the basis of your estimate will be. Dean, what is the level of accuracy we're talking about?
Well, looking at each stage in the life cycle of the asset and using the AAC classification system as a basis, then the estimates are at pre-development, typically class 5, because it's an estimate for the high-level economics. And as decommissioning is so far in the future, typically it is nothing more than a rudimentary estimate. From FEED, typically the development estimate is a class 2 or 3, but decommissioning is still typically only a class 5. Moving into operations, we have more detailed class 2-1 estimates for the operations budgets, and the decommissioning estimate is still, in my experience, a class 5. In late life of the asset, the decommissioning estimate will have improved, but is probably only a class 4 and 3 if a FEED has been completed. The concerning thing is the accuracy of the class 5 estimate is -20 to +100%. That is a wide range where the potential for significant cost increase is far greater than the potential for actually cost savings.
Thank you, Dean. To finish up with, the three main messages are: decommissioning needs to be considered at every part of the asset life cycle. In the pre-development phase, an estimate of the decommissioning cost will be included in the economic assessment, which is an input into assessing the feasibility and attractiveness of the project. In both the development and the operations phases, the decommissioning liability needs to be included in the company's financial accounts based on an accurate assessment of the liability in accordance with the strict accounting rules. Overall, more attention needs to be paid to the estimating of decommissioning costs, and an improved accuracy will come from having better defined scopes. Secondly, the timing of cessation of production and decommissioning can change significantly. And lastly, deferring removal of infrastructure can incur unnecessary extra cost and increase the decommissioning risk.
Thank you, Inika, and thank you to our guests, Dr. Robert Aguilera and Professor Grantley Taylor. Well, I hope you've enjoyed this discussion. If people are interested to find out more about decommissioning, we have created, in conjunction with Curtin University, more short podcasts on a variety of engineering, compliance and commercial topics, which will be available on the Curtin University Oil and Gas Innovation Centre YouTube channel as soon as they are released over the coming months. We encourage you to leave feedback and any suggestions for future podcasts. Thank you, and join us again soon.